Chapter 1, The Role of the Public Accountant in the American Economy. Our primary purpose in this chapter is to make clear the nature of independent audits and the accounting profession. We begin with the discussion of the broader concept of assurance services and then describe those assurance services that involve attestation, which includes audits of financial statements. The name assurance services is used to describe the broad range of information enhancement services performed by certified public accountants. In general, there are two types: those that increase reliability of information and those that involve putting information in a form or context that facilitates decision making. CPAs also provide other services that do not involve assurance, such as tax return preparation and planning, and management consulting services, which sometimes overlap with other assurance services. A major subset of assurance services is called attestation services. The standards define an attest engagement as one in which a practitioner is engaged to issue or does issue an examination, a review, or an agreed upon procedures report on subject matter, or an assertion about subject matter that is the responsibility of another party, such as management. The most common type of attestation engagement is a financial statement audit. There are three forms of attestation engagements: examinations, reviews, and agreed upon procedures. The level of assurance that is provided by each of these engagements is different, ranging from very high with an examination to merely a summary of findings with agreed upon procedures. The level of assurance provided by each type also corresponds with the risk of material misstatement, the nature of the assurance report, and the procedures used. This figure describes the attest function, which begins with subject matter that is the responsibility of another party, usually management. The CPA is engaged to report on the subject matter based on certain standards or suitable criteria. In order to report on the reliability of the subject matter, the CPA must gather evidence and then issue a report of the findings. As the previous slide stated, there must be some criteria or standards that the CPA uses to examine the subject matter. One type of attest function may be to report on the internal controls of a company, and in this case the standards are developed by a committee of experts in internal controls. Another example of an attest function is a financial statement audit, and in this case the standards used might be GAAP, generally accepted accounting principles, which are referred to as the applicable financial reporting framework. In a financial statement audit, the auditors undertake to gather evidence and provide a high level of assurance that the financial statements follow generally accepted accounting principles or some other appropriate basis of accounting. An audit involves searching and verifying the accounting records and examining other evidence supporting the financial statements. The evidence obtained and evaluated by the auditors focuses on whether the assertions that management has made about the financial statements are in accordance with the applicable financial reporting framework. The level of assurance that is provided in a financial statement audit is high. The procedures included in an audit will vary considerably from one engagement to the next because of the size of the company or organization, and the nature of the business will vary. Auditors perform audits of all types of businesses and governmental and nonprofit organizations as well. The auditor will gather sufficient relevant information that will be used to issue the audit report. The evidence that the auditor reviews will be used to determine if the assertions made by management are in accordance with the financial reporting framework, such as GAAP, and includes the following. Assets listed in the balance sheet really do exist, and the company has the right or title to those assets, and that all liabilities of the business are reported. Also, it would include evidence that sales have been recorded at appropriate amounts and that the recorded costs and expenses are applicable to the current period and all expenses have been reported. Finally, the auditors consider whether the financial statement amounts are accurate, properly classified, and summarized, and whether the notes are informative and complete. The contribution of the independent auditor is to provide credibility to the information. Credibility in this usage means that the information can be believed, that it can be relied upon by outsiders such as stockholders, creditors, governmental regulators, customers, and other interested third parties. Financial statements prepared by management and transmitted to outsiders without being audited by independent accountants leave a credibility gap. Misstatements can arise due to accidental errors, lack of knowledge of accounting principles, underestimation bias, or deliberate falsification. It is important to realize that audits are not intended to directly address general business risk, such as the company not being able to meet its financial obligations due to economic conditions or poor management decisions. This slide shows how the attest functions have developed throughout history to the current time. The original meaning of auditor was one who hears, and this was appropriate to the era during which governmental accounting records were approved only after a public reading in which the accounts were read aloud. As management of companies became separate from ownership, the function of the auditor has evolved through time to provide a level of protection for owners as well as other third parties. Corporate forms of ownership have allowed for large-scale enterprises that have become more and more complex. As a result, sampling procedures have become necessary in order to complete audits timely. Professional standards also began to emphasize fraud detection due to the number of large-scale frauds committed. Most recently, information technology and the use of the Internet to complete many business transactions has also changed the nature of auditing. But the basic objective of the financial statement audit has remained the same. This slide illustrates some of the pivotal points in the accounting profession's credibility crisis. In 2000, at the request of the Securities and Exchange Commission, the accounting profession established the Panel on Audit Effectiveness. This panel was charged with the responsibility of reviewing and evaluating how independent audits of financial statements were performed and assessing whether recent trends in audit practices served the public interest. Many large-scale frauds occurred around the same time, including Enron and WorldCom, that cast a dark shadow over the profession and rocked the stock markets and investor confidence in financial statements. As a result of these frauds, Congress passed the Sarbanes-Oxley Act in 2002, which included many reforms of the profession as well as the creation of the Public Company Accounting Oversight Board to develop and enforce standards for public accounting firms that audit companies which issue securities registered with the SEC. In 2010, the Dodd-Frank Act was passed as a result of the financial crisis of 2008 that developed after the collapse of the U.S. subprime mortgage market. It increased the regulations that govern financial markets. There are other types of audits that are also performed by auditors, and generally they consist of three types: Compliance audits, such as an audit by the IRS of someone's income tax returns, operational audits, which are used to determine the effectiveness of a particular unit of an organization, and integrated audits, such as the ones that are performed for publicly traded companies in the U.S. that include both assurance on the financial statements and the effectiveness of internal controls over financial reporting. There are not only different types of audits, but also different types of auditors. There are internal auditors who are employed by corporations, governmental and nonprofit organizations to investigate and appraise the effectiveness of their units in carrying out their assigned functions, governmental auditors such as those employed by the GAO, the Governmental Accountability Office, and tax auditors such as those that work for the IRS. A large part of the work of internal auditors consists of operational, compliance, and internal control audits. Although they do perform functions similar to external auditors, their projects vary from year to year. One important consideration for internal auditors is their placement in the organization and who they report to. They should have high placement in the organization and be independent of the department heads they are auditing. Preferably, they should report directly to the audit committee of the board of directors. The professional organization that issues internal auditing standards is called the Institute of Internal Auditors, and the certification they issue is called Certified Internal Auditor, or CIA. The Governmental Accountability Office has auditors that are responsible for compliance, organizational, and financial audits of governmental agencies. The head of the organization is the Comptroller General, and they are responsible for evaluating the effectiveness and efficiency of selected governmental programs and the operations of government contractors. Due to the sheer size of government operations, these audits have stressed using computer auditing techniques and statistical sampling plans. The Internal Revenue Service is responsible for administering the federal tax laws, and the IRS agents conduct compliance audits of both individuals and large corporations. State and local governments have tax auditors that are responsible for enforcing their income, property, and sales tax laws in their jurisdictions. The Certified Public Accountant, designated as a CPA, is licensed by a state and is represented by a voluntary national organization of more than 418,000 members called the AICPA. The traditional roles of the AICPA have been to establish standards and rules to guide CPAs in the conduct of professional services, carry on a program of research and publication, and contribute to the professional self-regulation of the profession. In the current time period, most of the standard setting and regulation for public companies has been taken over by the SEC and the PCAOB. The AICPA establishes principles for audits of non-public companies called non-issuers. These standards include statements on auditing standards and statements on standards for attestation engagements, which govern guidance on attesting to information other than for financial statement audits, such as financial forecast. The Accounting and Review Services Committee of the AICPA establishes standards for reporting on financial statements when the CPA's role is to compile or review the financial statements rather than to perform an audit. As part of the technical guidance that the AICPA provides, they publish both the Journal of Accountancy and the Tax Advisor. Other audit publications include specific industry and accounting guides. They issue audit risk alerts and auditing practice releases to update auditors on practice issues and developments in auditing procedures, as well as many other publications that are pertinent to accounting issues and research. One of the most important roles that the AICPA performs is in the area of continuing professional education programs that are necessary for continuing education requirements for maintaining the CPA certificate. Continuing education can also be provided by state CPA societies and other professional organizations. State laws govern the CPE requirements for CPAs that are licensed through a particular state. The regulation of accounting firms has been performed by the accounting profession itself through the AICPA. While the SEC has provided some guidance and some regulation, prior to 2002, Congress had enacted limited legislation to regulate the profession. This changed after Congress passed the Sarbanes-Oxley Act of 2002. Individual CPAs who are members of the AICPA are required to adhere to the Code of Professional Conduct, which is a set of positively stated principles on which CPAs can make ethical and appropriate decisions. Public accounting firms are regulated by the PCAOB if they are required to be registered because they audit public companies. Once they are registered with the PCAOB, they can become members of the AICPA Center for Audit Quality. If they are not required to be registered with the PCAOB, they are enrolled in the private companies practice section. Peer review by other accounting firms is part of the quality control for all public accounting firms. The CPA examination is a uniform national examination prepared and graded by the AICPA. The exam is computerized and consists of 4 parts: auditing and attestation, financial accounting and reporting, regulation and business environment and concepts. The examination consists of multiple choice questions and simulations which are designed to replicate real-world practice cases. State boards of accountancy are boards that issue permits to practice as a CPA and also regulate the profession and may suspend or revoke an accountant's certificate. While all state boards require successful completion of the CPA examination, the requirements for education and experience vary. The state boards are organized through the National Association of State Boards of Accounting, called NASBA. The state standard setting boards that auditors are familiar with are the Financial Accounting Standards Board, which sets GAAP for entities other than federal, state, and local governments. The FASB issues FASB statements, exposure drafts, holds public hearings, and conducts research projects that are of major concern to the public accounting profession in the United States. The GASB is the Governmental Accounting Standards Board and issues standards for state and local government. And the FASAB is the Federal Accounting Standards Advisory Board and issues accounting standards for the U.S. government. The International Federation of Accountants, or IFAC, is the global organization of accounting professional bodies, including the AICPA, and the purpose of the organization is to foster the development of consistent worldwide professional standards. As indicated previously, the PCAOB was created in 2002 to oversee and discipline CPAs and public accounting firms that audit public companies that issue securities. They register public accounting firms that audit public companies, perform inspections of the practices of registered firms, and conduct investigations and disciplinary proceedings. They can also sanction registered firms. The Dodd-Frank Act expanded the role of the PCAOB in 2010 to include audits of securities brokers and dealers. The Securities and Exchange Commission is an agency of the U.S. government that administers the Securities Act of 1933 and the Securities Act of 1934, as well as other legislation concerning securities and financial matters. It oversees the PCAOB. The primary function of the SEC is to protect investors and the public by requiring full disclosure of financial information by companies offering securities to the public. A second objective is to prevent misrepresentation, deceit, or other fraud in the sale of securities. A registration statement contains audited financial statements and is required to be filed with the SEC when a company wishes to sell securities to the public. Therefore, the SEC is a major user of financial statements. The legislation creating the SEC made the Commission responsible for determining whether the financial statements presented to it reflect proper application of accounting principles. This legislation was intended to protect the investor. To improve the quality of the financial statements filed with it and the professional standards of the independent accountants who report on the statements, the SEC has adopted a basic accounting regulation known as Regulation S-X, entitled Form and Content of Financial Statements. In addition to providing attestation and assurance services, most firms provide tax, consulting, accounting, personal financial planning, litigation support, and fraud investigation. CPA firms can be organized as a sole proprietorship or partnership, but most are organized as a professional corporation, limited liability partnership, or limited liability company. Professional accounting corporations differ from a traditional corporation in a number of respects. For example, the shareholders' directors must be engaged in the practice of accounting, and they may be held personally liable for the corporation's actions. Limited liability partnerships and companies offer limited liability or protection of the personal assets of the partners or members. Accounting firms differ greatly in size. They may be a single office or a local firm that has offices in 2 or 3 places. These firms tend to emphasize tax, consulting, and accounting services and do little auditing. Sometimes local firms will be purchased or will join together to become regional firms by merging. This usually is associated with an increase in the amount of auditing that is done in relation to the other services performed. National firms will have offices in most major cities in the United States and sometimes overseas on a limited basis. The largest firms are the Big Four: Deloitte, Ernst & Young, KPMG, and PricewaterhouseCoopers. These firms are international as well as located throughout the United States. A new type of practice is the alternative practice structures, which began in the late 1990s. Publicly traded companies such as American Express, CBiz Inc., and H&R Block purchased public accounting firms and then consolidated them into corporations. The approach is to purchase the non-attest function of the practice, hire public accounting firm partners and other personnel as employees of the publicly traded company to perform those services. The attest and auditing partners retain that status in the public accounting firm, but they are also employees of the publicly traded companies. Some public accounting firms are associated with specific industries and have a long history and specialized knowledge that helps to position them to make better judgments about audit evidence, suggestions to improve the client's operations, and generally have higher quality consulting services. This figure shows the typical structure of a national CPA firm that would be fairly large. At the top of the triangle are the partners, who are the executives and as such play a role in making strategic decisions about the firms. They are concerned with the long-run well-being of the organization and of the community it serves. They participate in leadership roles in the profession and in the community as well as the firm. The managers in the firm are the supervisors that perform many of the duties that would be discharged by partners in smaller firms. This involves supervising 2 or more concurrent audit engagements and responsibility for review of audit work papers and with handling the more difficult decisions that are made in audits. The seniors are the more experienced auditors who have been with the firm for 2 or more years and are responsible for the audits and supervising and training the staff auditors. Staff auditors are the new auditors with less than 2 years of experience who are learning audit procedures. Staff accountants perform most of the routine work in the audit, and this is the position that new college graduates are usually going to be hired as. After a period of time, the staff accountants will gain the necessary experience to become a senior or in-charge auditor. The auditors are responsible for training the staff accountants, reviewing the audit working papers, and maintaining the audit schedule. The managers are responsible for the overall engagement and will also review the working papers and have discussions with the audit staff and the client to resolve problems as they arise. At the end of the audit, the partner for the audit, as well as another partner that was not involved in the audit, will review the audit to ensure that the auditing standards were met and the audit working papers support the audit findings. And this is the end of the presentation for Chapter 1.